Hi, and welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. Jeff published last night, which was Monday, his weekly playbook at the end of the long weekend, which can be found on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content as well. Jeff, welcome back. How was your weekend?
Hey, great weekend, Mehdi. Great to be here. Thanks for having me on the show.
Absolutely. And, lots to chit chat about on the market. So, as always, let's dive in top down.
Yeah, as we've been writing for some time now, I believe that we're in the midst of one of the most restrictive monetary policy environments, that we've seen in at least the last 4 decades. And in my opinion, we are right on the cusp of the point where that restrictive policy regime starts to sink its teeth into the economy. A lot of people have been arguing for a recession for some time, ourselves among that crowd. And, the thing that's been frustrating is it's taken a while, right? But the reality is it generally does take about 12 months for policy actions to begin to have or trickle into the real economy. And we didn't really see the meat of those policy actions begin until around this time last year. We started to see 75 basis point hikes kick off in June. And, so we're coming up on that 1 year anniversary point. And I think that we're very close to seeing the impact on the economy begin to, kind of proliferate, if you will, throughout more areas of the economy than we've seen so far. So far, we've seen housing experience a fairly significant negative impact. Mortgage rates have doubled. The activity in the housing market has been exceptionally poor, with the exception of new construction. I think we're seeing it in orders, right? The PMIs are coming in negative on the manufacturing side. Services are still holding in a little bit better, but manufacturing is really where we get GDP growth kind of showing up. And we're also starting to see some evidence of employment data ticking up. I mean, the initial claims data in the most recent report showed an uptick. And so that's the first time we started to see that in some time now. And so, I think profits have been under pressure for some time. Many believe that, we've seen the worst of it. I continue to look at the earnings revisions breadth data, and it is poor. And so when we put all that together, I think we're looking at a situation where the fundamentals do not support the valuations in the market. We've got S&P 500, stocks trading at 19 times forward earnings. And that is about as high as I've seen them in a normal environment, other than the dot-com bubble, right? And really, if we take a look at what's driving this, it is those mega cap Magnificent Seven stocks that are trading at outrageous valuations, 39 times, or more than double what the market's trading at. And, if we just look at the rule of 20, the market should kind of be trading at a PE that equates to 20 minus the CPI, and the CPI is 4. So a PE ratio of 16 would probably be appropriate. And growth stocks may be trading at 150% of that if they're truly growing. Apple isn't growing. Nvidia might be. We'll see. They certainly have a great story to tell, but the most recent report showed a 13% year-over-year quarterly decline. And so, I'm not so sure that the growth dynamics exist to support these valuations. And so, when we look at the market, we see a 5-wave decline that began in January of 2022, and that decline ended in October of last year. And off of that low, we've seen a very overlapping sort of corrective waveform evolve that's extended far further than we expected, a couple hundred handles further than our original expectations. We had thought, a 50% retracement was probably in the cards. Normal's about 1/3 to 2/3. We're pushing 75% right now, and the next target that we have is the Fibonacci 786 retracement, which would get us up to around 45.34 on the S&P. I don't know if we'll get there. There's some interesting wave relationships that are already in place that suggest that we could be very close to a terminal point on what we believe is a counter trend advance within a larger degree, bear market cycle. And our expectation is that we will see this counter trend advance reach its terminal point in the not too distant future. And what follows will be something of what we expect to be an epic plunge. We think new bear market lows are in the cards, and that will occur before year end. And so, things have been pushed out from our original expectations of time, but, our models are not necessarily time dependent. We're using kind of just some, shoot from the hip judgment, if you will. And, with that, we continue to advise our clients to remain patient here, to not buy into a vertical ascent that appears to be long in the tooth with respect to the current market environment. And, just sit back, hold treasuries, minimize net equity if you're a long short fund, and collect your 5.3%. It's a fat pitch. You're getting half the market's long-term return risk-free for waiting it out. And we think that will pay off. If we're wrong about the market, and I don't think we are, but if we are, then there will be plenty of opportunities to adjust our course and get back into a sync. And we don't foresee that being the case, but if it is the case, we'll adapt eventually. And so we think patience and time is on your side.
So, Jeff, thank you for that overview of your thoughts on the market. Let's get a little bit into the weeds into your deck this week. So last week we discussed it as well, but let's get an update on the CNN Fear and Greed Index.
Yeah, we like this because it's a good graphic. Kind of gives people a good sense of where we've been and where we are right now. The CNN Fear and Greed Index just hit its, the high for the last 12 months, right? 82. 82 is kind of where we were back in February, where the broad market peaked, right? And, I think since that time, a lot has happened, particularly in the banking sector, which brought things, back to kind of a fear point. But we've rallied right back into that peak level of greed in this measure, which looks at a lot of 7 different measures of stock market performance and other related sort of measures. But it's not just the CNN Fear and Greed Index that's registering these high readings, these extreme greed readings. The DSI, which is the daily sentiment index that's put out by tradefutures.com, that hit 82% on Friday as well. And I think it's maybe 3 days in a row it's been there. The Investors Intelligence report, which looks at investment advisors, publishing analysts, et cetera, we're at 53% bulls. That's up 20 percentage points in the last 2 weeks. If we look at the name exposure index, last week it hit 90%. This week it pulled back a little bit, but we're still above 80%, which is very fully invested for professional investors. And the AAII survey jumped 30 percentage points in the last 2 weeks. I believe the bulls right now, are like 48%, if I'm not mistaken. But what's really important is the bull bear spread, and that's gotten up to about 28.5%. So 22.5% rather. And so that 22.5% level is 30 percentage points higher than it was 2 weeks ago, well off the lows of October 22, where we got to minus 42%. So we're a full 65 percentage points higher than the lows. And I think this suggests that the vast majority of investors have bought into this new narrative that we're in, kind of a new tech-driven bull market that will be, facilitated by a CapEx cycle for AI, artificial intelligence, which may be true. Okay, we could very well be in the very early innings of something like that. In fact, Microsoft recently came out and said, "Hey, we expect our AI revenues to be $10 billion on an annualized basis. Now, they weren't very specific about exactly when we could expect to see that. And they also didn't comment as to whether or not that would cannibalize their existing revenue base. But when I look at $10 billion on Microsoft, and I look at trailing 12-month sales of $208 billion, I can do a quick calculation, come up with that 4% of incremental revenues, if in fact it's not cannibalizing effect. So I don't think it's a huge deal, right? 4% is not a huge deal. And so I think we're a little bit out in front of our skis with respect to sentiment here.
See how this whole AI story unwinds, because I feel like you're right that the timeline seems to be getting a little aggressive on some people's investment thesis. We've been discussing some volatility over the last couple of weeks, but let's have a look at the volatility of volatility again, the VVIX.
Yeah, we like to juxtapose the VIX against the VVIX. The VIX being the volatility index, the VVIX being the volatility of volatility index, and there's a pretty close relationship between these two. The thing that interests us the most is divergences, right? When we start to see big divergences between VIX and the VVIX, that usually signals a trend change. When the VVIX puts in a lower high and the VIX makes a higher high, that usually signals that the VIX is going to turn down. And when the VVIX puts in a higher low and the VIX makes a lower low, as was the case on Friday, it usually is indicative of a trend change in the opposite direction. Our view is that the VIX is probably making its lows right here. The VVIX is signaling an imminent change. Once the VIX trades back above its 21-day moving average, I think we'll start to see what's commonly referred to as a volatility spike or a surge in the VIX to new highs. We've been saying this for a while. It sounds a little bit like a broken record, but in my opinion, I think the VIX will challenge its recent highs in the high 30s and possibly exceed that. My expectation is that the VIX will challenge 40%, a level we haven't seen the VIX print in over 2 years, and possibly exceed it by a wide margin.
So obviously this leads everyone to think, well, what's going to be the catalyst for these types of moves? But you've got the alarm bells going off on the black swan alert.
Well, we put 2 exclamation points behind it this week because, this is the second week in a row where we've seen the skew index rallied back above 150%. It got up to 157 last week. The previous high was 158. It then reversed hard down by about 10 percentage points. And so, that sharp reversal in the skew index suggests that maybe we've kind of hit that level that we're going to get a reaction out of. What skew measures, just for those who aren't indoctrinated, it looks at the probability of a left tail event, a tail risk event, right? So we're looking at 2 standard deviations below the mean in terms of, say, a downside move in the S&P 500 is really what the skew suggests. And the higher it gets, the higher the probability. Generally, we see kind of this range of 100, which is normal, and that would imply about a 2.3% probability of a left tail event, 2 standard deviations below the mean, right? When we get up to about 145, that would imply about 14.5% probability of a left tail event. Now, when we exceed that, those probabilities start to jump at a geometric rate. And so, the all-time record high was 170. That occurred a couple of months before the market topped. We think that, when skew gets this extended, and it can get extended when VIX is either high or low, but when it gets that extended and VIX is very, very low, and actually we just saw a 40-month low print on the VIX on Friday for a weekly closing basis, it tends to suggest that we're at a very elevated risk of a black swan event, an unexpected something that occurs in the real world that the options market isn't pricing in, right? And that is why that skewed index being elevated as it is represent such a risk, because if the VIX spikes up and the skew spikes down, you're going to see a massive reaction in the broad market. And so we expect that reaction will be a sharp reversal to the downside. And what this measure is really doing is it's alerting you to the fact that there is an elevated degree of risk that isn't being reflected in the options market right now.
So, Jeff, we all kind of see that it's been these big mega cap tech names that have been driving this bus. But is this still the case?
It is. And what's really interesting to me is that, four of the largest have made new 52-week highs in recent days and weeks. And three of those have made new all-time highs: Apple, Microsoft, and NVIDIA, to be specific. Google recently posted a new 52-week high. And, these are four of the largest market cap companies in the world, not just in the US, but certainly in the major US averages. And so the thing that stands out here is that oftentimes you can get some context about who's driving the bus, right? Is it fundamentally driven institutional investors that are buying these stocks to bid them up? Or is it retail investors that are performance chasing? And one of the measures that we look at to kind of distinguish which of those two cohorts is at the helm of this ship is to look at net block order flow. If it were institutions, we would expect net block order flow to be very, very high, to be tracking with the price of the stocks. And if it's not institutions, we would expect that relationship to be posting a large deviation. And here we're seeing a massive divergence between the price of these stocks and net block order flow, which in all four cases is plumbing multi-year lows right now, Mehdi. And so it's clear from this data that it is retail performance chasing that's driving these stocks more or less. And that's a risky proposition. It brings to mind a name in the market where that was, the same set of circumstances existed. And that name was GameStop, right? GameStop was a retail-driven name. It went parabolic. It reached levels that were unreasonable and unexplainable. And we've got an explanation for what's going on right now. I just don't think it's a reasonable explanation. I think AI is largely, it's 10% real and 90% hysteria at this point. And so the stocks are pricing in as though the narrative is 100% reality. And it's just not the case. And so, as institutions finally come to grips with reality and they have enough, they will become big sellers. And when they leave the party, retail will be left holding the bag. And you don't want to be a bag holder when these stocks come rolling over, because they'll bring the whole index down.
Jeff, there's never a good case to be a bag holder in anything. So I'm with you on that. So let's talk some technicals here. So got this chart titled Mother of All Melt-Ups or Wave 2. So what's happening here?
One of the things that we've been thinking about is, how the S&P is tracing out its waveform. And so, our methodology using the Elliot Wave principle is to count the major waves in decline at various degrees. And we've been able to count 5 waves down into the October low, as I mentioned earlier. And we count those at intermediate degrees. So that interval as complete counts as primary wave 1 down. The counter trend advance that we've been experiencing since will be primary wave 2 once it's complete. So what we wanted to kind of do is look back in time to similar situations where we had these extended wave 2 recoveries, right? And the one that really jumps out at us as being the most illustrative, as from an analog perspective. And I'm not a big fan of analogs, but in this particular case, it's actually not just an analog, but a fractal. And what we're explaining here in this chart is that if we look back to the 1999-2001 period in the NASDAQ 100, we can see that the advance was something of a parabolic advance into that 2000 high, that March of 2000 high. And we got an initial 5-wave decline. That five-wave decline occurred at minor degree, okay, because the entirety of that periodicity was at a lower degree of trend than we're at right now. That was actually tracing out cycle wave 4 down in the very, very early stages. We're in the very, very early stages of super cycle wave 4 right now. And so if we think about, the implications of that, we have to think about things at a higher degree of trend. Okay, so we're at we're tracing out primary degree right now. Back then, it was intermediate degree, and so intermediate wave 2 of the Nasdaq rallied some 43.4%. Okay, so far we've rallied 46.7%, I believe, in the Nasdaq 100. So it's fairly comparable, right? But what occurred once that intermediate wave 2 top was put in, slightly above the 61.8% retracement of the decline back in August of 2000? Well, it was followed by an epic 70% plunge over the subsequent 9 months. And so, we think about this as what are the implications for what we see today? We're just shy of a 78.6% retracement in the NASDAQ 100, okay? We're at primary wave 2, not intermediate wave. So it's going to be a larger degree decline, a more forceful decline. We believe once primary wave 2 terminates, what will follow is primary wave 3 down. And it should, similarly, evolve into that sort of a third wave plunge. I don't know if it's going to be a 70% decline. We're coming from a much higher level, obviously, but it could be. And I think that, it would be reflective of the past. They're basically fractals of one another. You're looking at, cycle wave 4 versus super cycle wave 4. And it wouldn't surprise me if they turned out to be very similar. The dot-com bust versus the EV/AI bust today. So that's kind of what we're looking at in that depiction.
So that's a nice breakdown on the Nasdaq. Let's have a look at the short-term kind of view on the S&P 500. Where what are your thoughts in the short term on this? Has anything really changed?
No, nothing's changed in terms of the pattern. We've been looking at the S&P as tracing out, a standard Elliott corrective waveform of the double zigzag variety. It's labeled WXY, okay? That's two zigzags that are bifurcated by an X wave, which is also an ABC. So these corrective waveforms are kind of standardized. Aaron Elliott observed them, he cataloged them, he illustrated them, he remarked as to the characteristics of these, looking at 75 years of Dow Jones Industrial Average data, closing prices taken from the Wall Street Journal day after day after day. He had a lot of time on his hands. He suffered from a malady that left him kind of bedridden and in a rocking chair for many years toward the end of his life. And so this is how he spent his time. And he discovered these patterns, right? And so, the pattern that we've kind of illustrated in this chart is it's textbook. It doesn't get any more textbook than this. It would be more textbook if it fell into the category of a 1/3 to 2/3 retracement. That's kind of the general vicinity, right? But it's not uncommon for corrective waveforms, especially second waves, to retrace far more than that. In fact, second waves can retrace up to 100%. Elliott documented this many, many times. And if you actually took a look at those NASDAQ charts again, you'd see that their initial minor wave 2 and intermediate wave 2s retrace something like 80 to 90%. And so it's not uncommon. It's less common for that to occur when you're at this degree of trend. That being said, a 786% retracement is not an uncommon thing. It's the square root of 61.8%. So another Fibonacci sort of ratio that we're looking at here. That level comes into play at 45.34. That's our working hypothesis right now. Now, again, admittedly, the market's carried further than our original expectations, right? But should we throw in the towel for an extra 2% or let the market just play out? There's another 2% upside here to that level. And, I think if we get there, that would be a very good time to expect the market to halt and reverse off of that, what we would expect to be the end of primary wave 2 in the S&P 500. And we would expect a break below 42.99 to strongly suggest that primary wave 3 down was now in progress. And that would be confirmed by a weekly close below 41.86, at which point we could definitively close that book and confirm that primary wave 3 down was underway. That will carry prices to new bear market lows, in our opinion, that are dramatically below the October lows. Our target levels for wave 3 alone are minimum 2,700 on the S&P. We think cycle wave A, once complete, once the full 5 waves down at primary degree are complete, cycle wave A should bottom around S&P 2250, which is where we see a convergence of key major support levels come into play. And we think it's a good place to expect the market to hold and develop a counter trend advance, which should ultimately evolve into wave B, cycle wave B. And cycle wave B will ultimately be followed by cycle wave 3 down to lower lows yet. And, we won't project that level until we see where cycle wave B terminates. That's going to be probably many, many months, if not years into the future. So we expect this entire super cycle degree corrective waveform to last upwards of a decade, perhaps even more.
Thank you for that, Jeff. Let's have a look at some sectors. Obviously, it's been quite well acknowledged that it's been tech-led, mega cap tech-led, top 7 names in mega cap tech-led kind of scenario here. So is that still the case? Do you see that changing? What are your thoughts here?
So we did see a modest bounce out of the smaller cap stocks in recent weeks, but that is fading. And what we've done here, we're looking at last week's performance across many market caps, and continues to look as though the NASDAQ 100 up some 3.8% last week as small caps barely registered in positive territory, right? Clearly leading the pack, okay? The inset chart is the ratio of the extended market, the Wilshire 40,500, that's the Wilshire 5,000 minus the S&P 500, divided by the S&P 500. So we're looking at that extended market divided by the core market. And that just barely bounced off its lows, well below trend and chart resistance. And it's fading aggressively now. And so, our view at this point is that we're not that optimistic that we're going to see any sort of follow through in these small caps.
Gotcha. And Jeff, any trading ideas? Oh, yes, we do. But you know what? People are going to have to sign up to your Substack. Don't forget, it's at hugeinsights.substack.com, and you get all the trading ideas on a weekly basis, long and short. So make sure you check that out. Jeff, as always, love your short thoughts from Alpha Insights, and thank you for sharing them with us.
Always a pleasure, Eddie.
And everyone watching, good luck investing.